Welcome to this explainer. Today we're unpacking a massive hidden deal that directly connects foreign governments to the money sitting right there in your wallet. You know, we're often told that the Federal Reserve controls our interest rates, right? But the crazy truth is your mortgage, your car loan, and honestly, your whole financial future are heavily tied to global forces in foreign nations. Let's get right into it.
Okay, so picture this. It's March 2026, and mortgage rates mysteriously spike. You probably asked yourself, wait, why? Mortgage applications fell, refinancing completely dropped off a cliff, but the Fed, they were holding rates steady. Inflation hadn't exploded either. So what actually happened? Well, war tensions abroad pushed U.S. Treasury yields up, and our mortgage rates were instantly dragged right along for the ride.
There's a quote from the source material that just perfectly captures this whole mystery. America's economy depends on a deal most people never knew existed. And the wild part? None of this is a secret. It's all right there on the public record. But it's this massive mechanism that rarely gets explained to the very people like us who are paying for it.
So, let's bring this down to the local level and look at exactly how much this invisible global bond market costs an average American family.
Here's how it works. When a foreign government suddenly needs cash, they usually do one simple thing. They sell off U.S. treasuries. And when they dump them into a volatile market, treasury prices fall, which makes long-term bond yields climb. Since American mortgages are basically built on top of those yields, your cost of buying a home goes up. In fact, studies show that if foreign nations suddenly sell roughly $141 billion in a single month, U.S. yields jump by 57 basis points. Some models even show a massive sale pushing it to around 100 basis points in just a month.
Okay, but what do those abstract basis points actually mean for you? Let's translate that math to a median new American home. A 50 to 100-point jump adds anywhere from $130 to over $260 a month to your mortgage payment. Every single month. For 30 years, we're talking tens of thousands of dollars just stripped from a family's wealth over the life of a typical home loan. It's literally thinning middle-class wealth in slow motion.
And it doesn't stop there. This single shift in some distant market sends a shockwave right down Main Street, spreading the economic pain far beyond just buying a house. The house stops rising in value, while the cost to keep it climbs. New home construction halts. Home renovations? Frozen. Jobs on framing crews and for electricians suddenly disappear. Even your car loans get pricier. And out of nowhere, a small business in a town completely disconnected from global bond markets finds its credit lines tightening up.
So if foreign bond selling is hiking up our mortgages, you're probably wondering who is actually shifting their money right now.
Well, let's look at one of our historically steadiest buyers, Japan. For a whole generation, Japanese investors used a really clever maneuver called the carry trade. This is where you borrow money in a currency with super low interest rates, like virtually free yen, to invest in assets with higher returns, like U.S. treasuries. This trade moved so consistently for so long that it acted like a hidden stabilizer, just sitting quietly underneath the entire U.S. treasury market.
But check out this shift. In late 2025, the Bank of Japan raised their rates to 0.75%. Suddenly, that practically free money vanished, and the profit gap started to close. With Japanese bond yields rising at home, investors had a real reason to bring their money back. So Japan pulled back right exactly when the U.S. needed to issue record debt. Talk about bad timing, right? It completely changed the balance underlying the whole system.
Now, while those foreign cushions were thinning overseas, there was a massive domestic pressure point quietly building up right here at home. Because Washington isn't the only borrower living or dying by interest rates. We had well over $1.5 trillion, yes, trillion with a T, in commercial real estate debt coming due across 2025 and 2026. And unlike a normal 30-year home mortgage, these loans don't just pay themselves off gradually. They come due in full. This forced borrowers into a corner, making them refinance in a completely different, much more expensive world compared to the low-rate era when they first got the debt.
This maturity wall hits some sectors incredibly hard, heavily squeezing regional and community banks. Just look at this breakdown. 35% of hotel mortgages and 24% of office mortgages came due in that single stretch. Think about how localized that pain is. With the huge shift to work from home, offices emptied out and lost tons of value, and hotels faced shrinking corporate travel budgets. So the banks holding these loans naturally got super cautious, which, you guessed it, tightened lending even more for small businesses and first-time homebuyers.
So what did the banks do? Instead of taking those massive losses on the chin immediately, they resorted to a maneuver known as extend and pretend. It's basically the corporate finance version of stuffing your bills into a drawer and hoping they magically disappear. Technically, it delays loan deadlines to avoid locking in losses, keeping the loans current on paper because payments are still being made under new agreements.
But those losses don't actually vanish. They just quietly accumulate, building up systemic stress until the system simply runs out of room to postpone things.
Now, what's really fascinating is how the Federal Reserve stepped in to build a structural backstop to prevent all these global and domestic pressures from totally collapsing the system. Back in September 2019, there was this severe liquidity warning where the overnight repo rate unexpectedly spiked from 2.4% to over 5%. The Fed realized, there isn't enough buffer in the system. So they created FEMA, the Foreign and International Monetary Authorities facility, during the 2020 pandemic. It started as a temporary safety net, but by July 2021 it was made a permanent standing facility. No massive public debate, no big vote, it just became a permanent fixture.
Let's walk through how this actually works, because FEMA essentially acts as a giant pawn shop for entire countries. If a foreign central bank needs US dollars right away, they don't have to sell their bonds on the open market, which, remember, is what drives up your mortgage rate. Instead, they just hand the Fed billions in US treasuries as collateral. They walk away with the cash, paying a slight 25 basis point markup, and then they just reverse the trade later when things stabilize. It's an incredible safety valve. And we actually saw exactly why this pawn shop exists recently during a major real-world crisis. During the February 2026 Iran war, oil supplies were choked off, which spiked inflation expectations and rapidly squeezed global dollar liquidity. Suddenly, even incredibly wealthy Gulf states needed fast cash. Because oil and sovereign wealth are priced in dollars, they needed that liquidity immediately. Now, Kuwait, for instance, holds a record $66 billion in U.S. treasuries. If they sold those outright on the open market, bond prices would crash, yields would spike, and they damaged their own portfolios while simultaneously crushing the American homebuyer. So instead of forced selling, they relied on the Fed's precautionary backstops, and that stabilized the treasury market.
So the crucial takeaway here is that this massive federal backstop isn't just a nice-to-have anymore. It is structurally required.
And it's required because the very nature of who buys American debt has fundamentally changed. We swapped out our old, reliable bond buyers, allied central banks who prioritize long-term geopolitical stability, for highly reactive private capital. Post-2024, foreign private investors like asset managers, hedge funds, and leveraged traders took over as the largest overseas holders of U.S. treasuries. They aren't in it for global stability. Their job is to react instantly to market shifts. That makes these emergency tools a permanent, everyday necessity just to keep the market calm.
To maintain this super fragile piece, the Fed's total commitment to rescuing the system since 2008 has absolutely ballooned. We're talking $29 trillion. Let that number sink in for a second. That is enough to pay off the vast majority of the entire U.S. national debt. But here's the kicker. Not one single dollar of that built a road or funded a school. All it did was buy time. It didn't provide a permanent fix to any of the underlying issues of our debt dependence.
So I want to leave you with this final, provocative thought. We now live in a system where global liquidity stress directly links a conflict overseas or a shifting foreign central bank policy right to the monthly payment on your house. If a $29 trillion emergency backstop is now just the new normal for the global economy, what happens to your family's future when that foundation finally cracks? Thanks for joining me for this explainer, and keep questioning what's really driving the numbers in your everyday life.